We are continuing our Wealth Wednesday discussion on down payments for your first home. If you missed last month's discussion with Yvonne Delry, we have it up on our website, and Yvonne is a FirstOntario Credit Union investment specialist, and she's registered with Credential Asset Management to provide investment advice. So let's pick up where we left off last month. What if you have an FHSA, a First Home Savings Account, and you end up not buying a house?
Yeah, so this is where we left off last month. So just to kind of recap the First Home Savings Account, it is specifically designed to save for the down payment of your first home. So we talked about contribution limits, which is $8,000 per year. The lifetime contribution limit is $40,000. It's tax deductible, and when you purchase your first home, it is not added to your taxable income. The planning part is that you can only have the First Home Savings Account for 15 years. So it is not open indefinitely. If in that 15 years you either change your mind or you don't purchase your first home, two things that you can do with the funds. You can either transfer them directly into your RRSP. You don't have to have contribution room, but it is not tax deductible again because you already received the tax deduction. Yeah. Or you remove the money in cash, but it will be taxable income in the calendar year that you remove it.
Okay, and these FHSAs, they're in addition to a whole line of products, government products that were introduced to entice people or to help people along in buying a home.
Yes, so previous to First Home Savings Accounts, there is a program through RRSPs. So we've talked about previously in Wealth Wednesdays, specific purpose of RRSPs is to save for retirement. However, there is a government program called the Home Buyers Plan. You can remove up to $35,000 to use for the down payment of a first home. This is not taxable income. There's no withholding tax when you remove it. However, in the second year of removing the money, you do need to repay it back into your RRSP within 15 years. So the expected repayment per year is 1/15 of what you removed.
Okay.
It is not tax deductible again, so there is a separate schedule when you do your income tax to show that it is a repayment into the Home Buyers Plan. You can use both of those programs together to their fullest extent.
Okay. And then what if you aren't buying, what if you've already had a first home and you're trying now to save for another home? Like a second one. You've sold, but you're moving up a little bit, you need some help with it. Is there anything that way?
Yeah, so if you have, well, if you've maximized out the two government programs for your first home, or yes, you are not a first-time buyer anymore, then the tax-free savings account is a good all-purpose savings strategy for any financial goal. So in this case, you can use it for the down payment of a home, which we've talked about previously as well. So it is an excellent choice. The contributions are not tax deductible, but then on the flip side, when you remove it, it is not taxable income, even the growth. So contribution limit for 2024 is $7,000. You can contribute after the age of 18, and the total contribution that you can have of your own money is $95,000. So it's a great option. So talk to your advisor to find out what option works best for you, or what combination of options work best.
Okay,
Plan, achieve.
So many acronyms. We all need help.
Yes,
that's where Yvonne comes in. We'll get the links up at our website, chch.com/morninglive. Again, the first conversation that we had about that will be up there as well.